Welcome back to the Deep Dive. Today we're embarking on quite a journey, I think, moving beyond the traditional financial statement audit into some really specialized areas of assurance services.
Absolutely. It's a fascinating space.
Our mission today is, well, crystal clear. We're diving deep into three critical standards on assurance engagements. That's SAE 3400, SAE 3482, and SAE 3420.
Yep, the three big ones in this area.
And we know many of you listening might be, a learner gearing up for a challenging exam, especially those case-based ones, right? They demand more than just rote memorization.
Oh, definitely. Application is key.
So our goal isn't just to, read the standards at you. It's to help you really understand them, to get the why behind the what, and to build that kind of intuitive familiarity with the language, the concepts, straight from the source material.
Getting comfortable with the official terminology is so important for exams.
Exactly. We're going to unpack these ideas, look at some real-world scenarios, and even tackle a specific case study later on, all designed to make these complex topics, stick and prepare you for whatever an exam might throw your way.
Sounds like a plan.
Okay, let's unpack this.
What's fascinating here, I think, is just how much the whole landscape of professional assurance has shifted.
How so?
Well, for ages, the main focus was almost entirely on historical financial data, right?
Right.
Looking backwards at what had already happened.
Standard audit stuff, yeah.
But think about today's business world. You've got banks lending for future projects, investors weighing up new ventures, regulators needing transparency on complex outsourced operations.
Right, the demands are different.
Exactly. These stakeholders need confidence not just in the past, but crucially in the future.
Right.
And in the systems, the controls that ensure reliability going forward.
Wow.
And these three standards, they're really at the forefront of addressing that growing need. They allow us as professional accountants to provide credibility to a much, much broader range of information.
So it's about confidence beyond just the historical financials.
Precisely. It's about giving confidence not just in where a company has been, but where it might go, and critically, how its important operations are managed day to day.
Okay, so let's kick things off then with the first one. SAE 3400. The title itself tells you a lot. The examination of prospective financial information.
Yep, PFI for short.
Now, when we say prospective financial information, or PFI, what exactly are we talking about here? This isn't your typical balance sheet, is it?
Oh, absolutely not. PFI, as the standard defines it, is financial information that's based on assumptions about events that may occur in the future, and importantly, possible actions an entity might take.
May occur, might take. Sounds quite uncertain.
That's the key takeaway, future and possible. It's inherently forward-looking, and because we're dealing with the unknown, its preparation requires, well, considerable judgment from management.
So it's not just reporting facts.
Not at all. It's about articulating expectations or sometimes exploring what-if scenarios.
And I gather PFI isn't just one single thing. It can, take different forms.
That's correct. The standard is very clear in differentiating between two main types. You have a forecast and you have a projection.
Forecast and projection.
I know. It can even be a combination of both. You might see, for example, a company issue a detailed forecast for the next year, followed by a perhaps broader 5-year projection.
Right, okay. So what is the big difference between a forecast and a projection? I'm guessing it comes down to the assumptions they're built on.
You've hit the nail on the head. It's all about the assumptions. A forecast is PFI that's prepared based on what the standard calls best estimate assumptions.
Best estimate, meaning what management really thinks will happen.
Exactly. This is management's clearest view of what they genuinely expect to happen. Think of it this way. Management expects these specific events to take place and these specific actions to occur as of the date the information is prepared. So, for instance, if a CFO looks at historical sales trends, current market data, maybe planned marketing campaigns, and confidently predicts, say, a 5% sales increase next quarter, that's a forecast.
Because they expect it.
Yes. And the phrase best estimate assumptions is crucial. It implies management believes these reflect their anticipated experience, and importantly, with no provision for risk of adverse deviation.
Ah, so they're not hedging their bets.
Pretty much. They're not building in a safety net for things going unexpectedly wrong. They genuinely anticipate this specific outcome based on their best judgment at the time. It implies a higher degree of certainty in their mind.
Okay, that makes sense for a forecast.
Yeah.
What about a projection then? How's that different?
A projection, well, it's a different beast entirely, as you said. It's PFI based on hypothetical assumptions.
Hypothetical, like made up.
Not necessarily made up, but relating to events and actions which are not necessarily expected to take place. This is where those what-if scenarios really come into play.
Give me an example.
Okay, think about a startup company seeking funding. They don't have historical data, right? So they're projecting based on assumptions about market entry, adoption rates, things like that.
Things they hope will happen but aren't certain.
Exactly. Or take a well-established company considering a major strategic shift, maybe diversifying into a completely new product line. They might create a projection to show what their financials would look like if that new product achieved a certain market share.
So it illustrates possibilities.
Precisely. It's about illustrating possible consequences under specific, often imagined conditions. It allows stakeholders like banks or investors to evaluate desired outcomes if those conditions were actually to materialize. And yes, a projection can also be a mixture of best estimate and hypothetical assumptions.
This brings us to something you mentioned earlier, which I think is, well, maybe one of the most crucial takeaways from this standard. You said an auditor cannot express an opinion that the results shown in PFI will actually be achieved.
Yes, absolutely critical.
Why is that such a strict limitation?
It's probably the single most fundamental principle when auditing PFI. You see, PFI, just by its very nature, deals with future events and actions, things that simply have not yet occurred and might not occur.
Right, you can't audit the future.
Exactly. While an auditor will certainly gather evidence to support the assumptions management has made, that evidence is generally future-oriented and therefore speculative in nature.
Speculative, unlike historical audits.
It's a stark contrast. When you audit historical financial statements, you're looking at past transactions, things that have already happened. The evidence is typically objective, verifiable. Think invoices, bank statements, contracts.
Much more concrete.
Totally. But with PFI, because of this inherent speculative nature, it's virtually impossible for an auditor to get to a level of satisfaction that would allow them to give a positive expression of opinion.
Positive opinion, meaning
Yeah.
like a guarantee.
Essentially, yes. A statement saying, these assumptions are free of material misstatement, or this PFI will come true, they just can't do that. Therefore, auditors provide only a moderate level of assurance on the reasonableness of management's assumptions.
Moderate assurance, not high assurance like a regular audit.
Correct. And it's often expressed as negative assurance. Think of it like inspecting a bridge. With positive assurance, you're saying, this bridge is absolutely 100% safe.
Okay.
With negative assurance, which is what we typically see here with PFI assumptions, you're saying something more like, I've walked over this bridge, I've checked its nuts and bolts, and nothing has come to my attention that makes me believe it's unsafe.
Ah, so it's about what you didn't find.
Exactly. It's a statement about not finding evidence to the contrary, not a guarantee of absolute perfection or future performance. It's a subtle but hugely important distinction.
And this isn't just like auditing best practice. It's actually codified somewhere.
Oh, very much so. This limitation ties directly into a really significant provision in our professional code of conduct here in India. It's Clause 3 of Part 1 of the Second Schedule to the Chartered Accountants Act, 1949.
Okay, what does it say?
It explicitly states that a chartered accountant is deemed guilty of professional misconduct if they, now get this, vouch for the accuracy of the forecast.
Vouch for the accuracy. Wow. Okay, so you absolutely cannot do that.
Absolutely not. It's a serious point. Now, the clause clarifies that CAs can associate their name with PFI, by helping prepare it or reviewing it, but they must indicate clearly in their report the sources of information, the basis of forecasts, and also the major assumptions made, and crucially, so long as they do not vouch for the accuracy of the forecasts.
And that applies to projections too, not just forecasts.
Yes, equally to projections. Your assurance, your report, is about the process, the basis, the reasonableness of the assumptions, not about whether the final numbers will actually happen.
Given this delicate balance then, what are the core duties of the member examining PFI? What are the key things an auditor needs to get comfortable with?
The auditor's job boils down to gathering enough solid, appropriate evidence to feel satisfied about four main things.
Okay, four things.
First, for management's best estimate assumptions, they need to be satisfied that these assumptions are not unreasonable.
Not unreasonable. Doesn't sound like a high bar.
It reflects the nature of the evidence. You can't prove they are reasonable, but you can check if they seem plausible and not based on, say, wishful thinking. And for the hypothetical assumptions and projections, the auditor needs to be satisfied they are consistent with the purpose of the information.
Meaning they fit the what-if scenario being presented.
Precisely. You're not saying the assumptions will happen just so they make logical sense for the stated objective. Second, the PFI itself must be properly prepared based on those assumptions. Do the numbers actually follow logically from the assumptions made?
Okay, makes sense.
Third, the PFI has to be properly presented, and this is key. All material assumptions must be adequately disclosed. You have to clearly indicate whether they are best estimate or hypothetical. Transparency is paramount here.
Got it. And the fourth?
Finally, the PFI must be prepared on a consistent basis with historical financial statements using appropriate accounting principles. So, if the historical statements used accrual accounting, the PFI should generally follow suit unless there's a very clear, disclosed, and justified reason for a change. Consistency matters.
Okay, so before even starting the examination work, what about accepting the job in the first place? What are the crucial considerations for acceptance of engagement? Are there times an auditor just has to say no?
Yes, absolutely. This initial phase, acceptance and continuance, is vital. It sets the right foundation. The auditor must consider things like, what's the intended use of the PFI? Is it for a broad general audience or maybe just for a limited group like a specific bank?
Why did that matter?
Because the level of detail and the nature of assumptions might differ. Also critical is the nature of the assumptions themselves. Are we dealing mainly with best estimates or hypotheticals? What specific financial elements are included? What period does the PFI cover?
Okay.
And here's a really important point, a non-negotiable red flag. An auditor should not accept or should withdraw from an engagement when the assumptions are clearly unrealistic, or when the auditor believes that the prospective financial information will be inappropriate for its intended use.
Clearly unrealistic.
Yeah.
So if management's projecting, I don't know, 1,000% growth with no basis.
Exactly. Or if they want to use a highly specific projection designed for internal planning in a general public fundraising document, if it's fundamentally flawed or inappropriate for its intended use, the auditor must walk away. It's a professional safeguard.
That makes sense.
And of course, like any engagement, you need a proper engagement letter following SA 210 to formalize the terms, clarify the scope, and spell out management's responsibilities very clearly.
Right. So assuming the engagement is accepted, how do auditors actually perform the examination procedures? What kind of things guide their work? How deep do they go?
Well, the nature, timing, and extent of the procedures are always tailored to the specific engagement. There's no one-size-fits-all checklist. We consider a whole range of factors.
Okay.
Things like, what do we already know from previous work with this entity? How competent does management seem in preparing PFI? What's the inherent likelihood of material misstatement? How much judgment did management have to exercise?
Okay.
We also scrutinize the sources and the reliability of the underlying data management used. Was it mostly internal data, like detailed departmental budgets or existing loan agreements? Or was it external data, perhaps from government publications, industry reports, or economic forecasts? How reliable are those sources?
Right. Garbage in, garbage out.
Precisely. We also assess the stability of the entity's business environment. Is it a very volatile industry? And, of course, the experience level of our own engagement team plays a role. All these factors influence how much evidence we need and how deeply we need to dig.
You mentioned hypothetical assumptions earlier. Are there specific procedures around those?
Yes, definitely. This is where it gets really practical, especially for exam purposes. For hypothetical assumptions, the auditor must consider all the significant implications.
Significant implications, meaning?
Let's say a projection assumes a massive increase in sales, okay? Maybe far beyond the entity's current manufacturing capacity.
Right.
Then the PFI must logically reflect the associated costs of achieving that. It can't just show huge revenue growth in isolation. It needs to include the necessary investment in, say, a new plant, or the cost of outsourcing production, or hiring and training additional staff.
The whole picture has to hang together.
Exactly. These hypothetical assumptions must not only be consistent with the purpose, meaning they logically support the what-if scenario, but also not clearly unrealistic. You can't just pluck a completely impossible number out of thin air, even for a projection.
Okay. What else?
The auditor also has to be satisfied that the PFI is properly prepared. This involves procedures like recomputing calculations, basically checking management's math and checking for internal consistency.
Like making sure changes in sales volume flow through to cost of goods sold.
Exactly. Or making sure changes impact working capital figures correctly. We focus a lot on what we call sensitive areas.
Sensitive areas.
Yeah, these are the elements or assumptions where even a small change could have a big material impact on the overall results. Maybe it's the assumed interest rate or a key commodity price. These sensitive areas demand more extensive evidence gathering and very careful disclosure in the notes.
Makes sense.
We also need to consider procedures if the PFI includes an elapsed portion of the current period.
Meaning, part of forecast period has already happened.
Right. If the PFI covers the current year, and we're already, say, 6 months in, then that first 6 months is technically historical data now. The auditor needs procedures to ensure that historical information incorporated into the PFI is reliable.
Okay. And written representations.
Always crucial. We obtain written representations from management. This is their formal sign-off, acknowledging things like the intended use of the PFI, the completeness of all the significant assumptions they've provided us, their ultimate responsibility for the PFI itself, and disclosure of any uncontrollable factors or potential litigations that could significantly affect the outlook. It basically locks down their commitment and confirms what they've told us.
So after all that rigorous examination work, how does an auditor make sure the presentation and disclosure of the PFI isn't misleading? What are the absolute must-haves?
The guiding principle here is that the PFI must be informative and not misleading. That sounds simple, but it covers a lot.
Like what?
Well, the accounting policies used and, critically, the underlying assumptions must be clearly disclosed in the notes to the PFI. You have to explicitly state whether each significant assumption is a best estimate or a hypothetical one.
Transparency is key.
Absolutely. And for any areas that are both material and highly uncertain, those sensitive areas we talked about, the uncertainty and resulting sensitivity of the results to changes in those assumptions must be adequately disclosed.
So users understand the potential volatility.
Precisely. Imagine a scenario where a 1% change in interest rates could swing the projected profit massively. That kind of sensitivity needs to be highlighted.
What else needs disclosing?
The data preparation must be disclosed, and management has to confirm that the assumptions were appropriate as of that specific date. If the results are presented as a range, say profit between $6 and $, the basis for establishing that range must be transparent, and the range itself shouldn't be biased or misleadingly wide or narrow. And finally, if there are any changes in accounting policy compared to the historical financial statements, these must be explicitly disclosed, along with the reasons for the change and, if practicable, their financial effect. Clarity, transparency, consistency, those are the watchwords. And then we finally arrive at the actual output, the report on examination of prospective financial information. This isn't just a simple letter. It's a very specific, highly structured document.
How structured?
It typically contains no less than 13 essential elements, all designed to ensure the necessary information and, importantly, the necessary disclaimers are present.
13 elements. Can you list some key ones?
Sure. You need a clear title, the addressee, who the report is for, clear identification of the PFI itself, a crucial reference to the standards used, so SAE 3400, a statement outlining management's responsibility, and, if applicable, a reference to the specific purpose or any restricted distribution of the PFI.
Okay, that covers the context. What about the auditor's part?
Then it states that the examination procedures were performed on a test basis. And then comes the absolute heart of it, a statement of negative assurance as to whether the assumptions provide a reasonable basis for the prospective financial information.
That negative assurance phrase again.
Yes. Followed by the auditor's opinion on whether the PFI is properly prepared based on those assumptions and properly presented. Then come the appropriate caveats concerning achievability, warning users the results might differ. And finally, the date, the place, and the auditor's signature.
Can you just reiterate those core statements within the report? They seem really important to get right.
Absolutely, because they are frequently misunderstood or misstated. The report will contain wording very close to this. Based on our examination of the evidence supporting the assumptions, nothing has come to our attention which causes us to believe that these assumptions do not provide a reasonable basis for the prospective financial information. That's the negative assurance on the assumptions.
Got it.
Then, it expresses an opinion, a positive one, usually on whether the PFI is properly prepared on the basis of those assumptions and presented in accordance with the relevant financial reporting framework.
Okay, and the caveats.
The caveats. Absolutely vital. The first one is universal for all PFI, forecasts, or projections. Actual results are likely to be different from the prospective financial information since anticipated events frequently do not occur as expected, and the variation could be material. This is non-negotiable. It protects everyone against the perception of a guarantee.
Manages expectations.
Exactly. And specifically for projections, because they contain those hypothetical assumptions, there's an additional caution. Something like, the PFI should not be used for purposes other than the above-mentioned intended use. This ensures users understand the specific, often limited context and applicability of the projection.
So what happens if things aren't quite right? If the PFI has issues? When would an auditor issue a modified opinion or maybe even withdraw?
This is where the rubber really meets the road, professionally speaking. An auditor might have to express a qualified opinion, or perhaps an adverse opinion, or even withdraw entirely if the presentation and disclosure of the PFI are inadequate.
For example.
For instance, if management fails to disclose the significant consequences of highly sensitive assumptions. If users aren't warned about major uncertainties, the PFI could be misleading.
Okay. What else triggers a modification?
If one or more of the significant assumptions are deemed unreasonable, whether they're best estimate assumptions in a forecast or hypothetical ones in a projection, then an adverse opinion or withdrawal is necessary. This is critical. If the foundation, the assumptions, are fundamentally flawed, the auditor simply cannot provide any meaningful assurance.
Right, the whole thing collapses.
Pretty much. And just like in any assurance engagement, if there are scope limitations, meaning the auditor is prevented from applying necessary procedures to get sufficient appropriate evidence, then a disclaimer of opinion, saying you can't form an opinion, or withdrawal from the engagement is warranted. You can't opine if you couldn't do the work needed.
Okay, let's try and make that concrete with a test your understanding scenario.
Yeah.
This sounds exactly like something you might face in an exam. Imagine you're CA Himant. A company asks you for an assurance report on their PFI for a new project. As you're reviewing it, you discover something odd. Depreciation on the proposed new fixed assets has been calculated using Income Tax Act rules, not standard accounting principles.
Uh-oh.
And to make it worse, there's absolutely no disclosure explaining this deviation. How should you, as CA Himant, proceed?
Right, this is a classic scenario testing consistency and disclosure.
Yeah.
The PFI is explicitly supposed to be prepared on a consistent basis with historical financial statements using appropriate accounting principles.
Which income tax depreciation usually isn't, right?
Exactly. By using tax rules instead of accounting principles for depreciation, the PFI is fundamentally not proper in its preparation. It's inconsistent with the expected accounting framework and the lack of disclosure. That just compounds the problem, making the presentation and disclosure inadequate and potentially misleading.
So what's the outcome for the report?
Well, depending on how material this misstatement is, how much it impacts the overall numbers, and crucially on management's willingness to correct it, your report would almost certainly need to be modified.
Modified how?
You might issue a qualified opinion if the impact is sort of isolated and you can clearly explain the deviation and its effect. Or if the deviation is pervasive, meaning it affects many parts of the PFI and fundamentally misleads the reader, you'd likely need to issue an adverse opinion stating the PFI is not properly prepared or presented.
And withdrawal.
In a worst-case scenario, yes. If management absolutely refuses to rectify such a significant fundamental issue, you would likely need to withdraw from the engagement altogether. This isn't just a minor technicality. It goes to the heart of ensuring the PFI provides a fair, consistent, and understandable representation.
That's very clear. And finally, just a quick but important point on documentation for SAE 3400. What's the requirement there?
Documentation, as always, is the auditor's memory and their proof of work. It must be sufficient to enable an experienced auditor, someone with absolutely no prior connection to this specific engagement, to fully understand what was done.
Understand what, specifically?
Understand the procedures performed, the results found, the evidence gathered, and any significant matters or professional judgments made during the engagement. This includes documenting the sources of information used, the basis for the forecasts and assumptions, the rationale for concluding on their reasonableness, and, importantly, the reasons for any modified opinions or decisions to withdraw. It's about creating a clear audit trail that stands up on its own.
Okay, we've just navigated the sometimes speculative world of future forecasts and projections. But what happens when a company outsources a really critical function? Maybe their entire payroll processing, or their IT data center, or even inventory management.
Yeah, outsourcing is incredibly common now.
So how do the auditors of the company that's using the user entity get any comfort, any assurance on the controls operating at that external service provider.
Ah, that is precisely where SAE 3402 comes into play. The standard is titled Assurance Reports on Controls at a Service Organization.
Service organization controls. Okay.
This standard is incredibly important in today's interconnected business world. Its whole purpose is to allow a professional accountant, we call them a service auditor in this context, to issue a formal report on the controls operating at a service organization.
The outsourced provider.
Exactly. And this report is then designed specifically for use by the user entities, the companies that employ the service organization, and crucially, by their auditors, the user auditors.
Why is it so crucial for the user auditors?
Because the service provided by the service organization is often likely to affect the user entity's own internal control, particularly as it relates to financial reporting.
Can you give an analogy?
Sure. Think of it like this. Imagine a large restaurant chain that's the user entity. They decide to outsource their entire customer reservation and online ordering system to a specialized tech company that's the service organization.
Okay.
SAE 3402 allows the restaurant chain's auditors, the user auditors, to get a report from the tech company's auditors, the service auditors, on how well that tech company's controls ensure accurate reservation capture, secure payment processing, and reliable data security.
All of which could definitely impact the restaurant's revenue or customer data integrity.
Absolutely. So this SAE 3402 report directly complements the user auditor's work under a different standard, SA 402, which deals with using service organizations. It provides them with vital evidence about controls operating outside the user entity itself.
So the scope of SAE 3402 is quite specific then. It's not just for any controls at a service organization.
That's right. It applies specifically when the service organization is responsible for, or at least can take an assertion about, the suitable design of controls relevant to the service provided to user entities.
And when does it not apply?
It specifically does not apply if the report is only about whether controls operated exactly as described without evaluating if that design was actually suitable. Or, importantly, if the controls being reported on are not related to a service that could impact the user entity's financial reporting.
So it has to link back to financial reporting controls, essentially.
Yes, that's the core focus. It's squarely aimed at those controls within a service organization that have a direct or indirect bearing on a user entity's financial reporting processes. And this focus leads us directly to the clear objectives of the service auditor under SAE 3402. There are basically two main objectives.
Okay, what's the first one?
The primary objective is to obtain reasonable assurance, remember, that's high but not absolute, assurance that in all material respects and based on suitable criteria, three things are true.
Three things.
Yes. One, that the service organization's description of its system fairly presents the system as it was actually designed and implemented. Two, that the controls related to the stated control objectives were suitably designed.
Suitably designed to meet those objectives.
Exactly. And three, crucially, if it's within the scope of the engagement, which means for Type 2 reports only, that those controls also operated effectively to achieve the control objectives throughout a specified period.
Okay, description, design, and sometimes operating effectiveness. What's the second objective?
The second objective is simply to issue a comprehensive assurance report on these matters, based on the findings from their examination.
You mentioned Type 2 reports only for operating effectiveness. This brings us to what sounds like a really critical distinction, one that often trips people up. The difference between a Type 1 report and a Type 2 report. Can you break that down for us?
Absolutely. This is fundamental to understanding SAE 3402, and you'll definitely want to get this clear for any exam. Let's start with the Type 1 report.
Okay, Type 1.
Think of a Type 1 report as essentially a snapshot in time. It's a report on the description and design of controls at a service organization as at a specified date.
Just description and design at one point in time.
Exactly. It includes the service organization's detailed description of its system, their written assertion, management statement, that the description is fair and that the controls were suitably designed as of that specific date, and then the service auditor's report providing reasonable assurance on those 2 points, fair presentation of the description, and suitable design of controls.
What's the key thing it doesn't include?
The critical differentiator for a Type 1 report is that it does not include testing of the operating effectiveness of those controls. It's like reviewing the detailed blueprints of a secure building and confirming the design looks sound on paper at that specific moment. But you haven't checked if the alarms actually work day to day.
Okay, that makes sense. So what about a Type 2?
Right. A Type 2 report takes that a significant step further. It's a Report on the description, design A&D operating effectiveness of controls at a service organization throughout a specified period.
Ah, so it covers a period of time, not just a point in time,
And
and includes effectiveness.
precisely, it includes everything a Tech 1 report does: the description, the assertion on fair presentation and suitable design, plus the service organization's assertion that controls operated effectively throughout the specified period, usually 6 months or a year.
And the service auditor's report reflects that.
Yes. Consequently, the service auditor's report for a Type 2 engagement includes a detailed description of the tests of controls performed and the results thereof. This is key. It tells the user auditor what tests were done, how many items were tested, and what the outcome was. Oh, gee, were there any exceptions?
So it's like not just reviewing the building's blueprints, but actually living in the building for, say, a year, testing the security systems, the fire alarms, watching the guards, and confirming they consistently work properly over that whole period.
That's a great analogy, yes. It provides evidence about whether the controls were not only designed well, but actually worked in practice over time.
So if I'm an auditor for a user entity, the company using the service, I'd almost always prefer to get a Type 2 report, wouldn't I? Seems much more useful.
Oh, absolutely. From a user auditor's perspective, a Type 2 report is generally far more valuable, especially if they want to rely on the service organization's controls to potentially reduce their own audit testing at the user entity.
Why?
Because it provides evidence not just of the design of controls, but also their operating effectiveness over a period. This is the evidence the user auditor needs under SA 402 to assess whether they can place reliance on those controls. A Type 1 report only helps understand the design. It doesn't support reliance on effectiveness.
Okay. Type 2 is generally the goal for reliance. What are some of the other key requirements for service auditors when they take on these SAE 3402 engagements, beyond the obvious ethical stuff like independence?
Right. Well, beyond the fundamental ethical requirements, including being independent from the service organization itself, although interestingly, the service auditor doesn't necessarily need to be independent from each and every user entity. There are several key requirements.
Like competence.
Yes. First, the service auditor needs to ensure they actually have the necessary capabilities and competence for this rather specialized type of work. It's not quite the same as a standard financial audit.
And management's role.
Management at the service organization must agree to provide a reasonable basis for its assertion. Remember, they assert about the description, design, and effectiveness, and they must grant the service auditor full, unrestricted access to all relevant information and personnel needed.
What if they try to limit access?
If management tries to limit the scope or access, or if their fundamental assumptions for the assertions seem clearly unrealistic, the service auditor should probably withdraw from the engagement. You can't do the job properly without full cooperation.
Makes sense. What about criteria?
Yes. A significant element is assessing the suitability of criteria. The service organization must have used appropriate and reliable criteria for describing its system, for evaluating the design of its controls, and for Type 2 reports, for evaluating their operating effectiveness.
Criteria like COSO or something similar.
Often, yes, established frameworks like COS are used, or sometimes criteria developed specifically for the industry or service. The key is that these criteria need to be objective, measurable, complete, relevant, and, importantly, available to the intended users of the report so they understand the benchmark against which the controls were assessed.
And materiality. Is that judged differently here?
Yes, the concept of materiality in an SAE 3402 engagement relates to the service organization system being reported on, not directly to the user entity's financial statements. We're looking at what kind of misstatement in the description or failure in control design or operation would be significant enough to influence the decisions of a user entity or their auditor relying on this report.
Okay, different focus.
Yeah.
And understanding the system.
Absolutely critical. The service auditor must gain a thorough understanding of the service organization's system and its related controls. This understanding helps in defining the boundaries of the system being reported on, assessing whether management's description fairly presents it, identifying the key controls, and planning the tests for design and operating effectiveness.
Now, when it comes to actually obtaining evidence for the description, how deep does that go? And you mentioned outsourcing earlier. What if the service organization itself uses another company, a subservice organization? How is that handled?
Excellent question, because subservice organizations are very common in practice. Let's break it down. For the description itself, the service auditor will read and evaluate the service organization's narrative description of its system. They need to be satisfied it's a fair presentation.
What does fair presentation involve checking?
It involves assessing if the control objectives stated by management are reasonable in the context of the service. Are the controls they identified actually implemented? And are any complementary user entity controls adequately described?
Complementary user entity controls. What are those?
Good point. These are controls that the service organization assumes the user entity will have in place for the overall control objectives to be met. For example, a payroll processor might assume the user entity has controls to ensure only valid employees are submitted for payment. The service organization's report needs to make clear what the user entity is responsible for.
Okay. Now, back to subservice organizations.
Right. There are two main ways a service organization can handle a subservice organization in their description, and consequently, how the service auditor deals with it. These are the inclusive method and the carve-out method. You need to know the difference.
Okay, inclusive versus carve-out. Let's start with carve-out.
In the carve-out method, as the name suggests, the subservice organization's relevant controls are excluded, carved out from the main service organization's description, and therefore, they're also excluded from the scope of the service auditor's testing.
So the service auditor doesn't look at the subservice organization's controls at all.
Not directly. What typically happens is the main service organization will have its own controls in place to monitor the effectiveness of the subservice organization's controls. Maybe they review performance reports, hold regular meetings, conduct site visits, or even get their own assurance report from the subservice provider. The service auditor, in this case, would test the monitoring controls at the main service organization.
Okay, like checking if the bakery properly checks the quality control reports from its outsourced flour blender.
Exactly, that kind of thing.
So what's the inclusive method then?
In contrast, under the inclusive method, the subservice organization's relevant controls are included within the service organization's description of its system. And consequently, the service auditor's procedures extend to testing the controls at the subservice organization as well.
So the service auditor actually goes and tests controls at the subservice place.
Yes. This might be feasible if, say, the subservice organization is a related party, or if there's a specific contractual agreement allowing the service auditor direct access. Under this method, the bakery's auditor would actually go to the flour blender's factory and check its quality control processes directly.
That sounds more thorough, but maybe harder to arrange.
It can be. The method chosen depends on the relationship and the practicalities. But in either case, carve-out or inclusive, the service auditor still needs to confirm the implementation of controls at the main service organization itself through procedures like observation, inspection of documents, and inquiry.
Okay, that covers the description and subservice handling. What about obtaining evidence regarding the design of controls?
For design effectiveness, the service auditor first needs to identify the controls that are necessary to achieve the stated control objectives. Then they assess whether these identified controls are suitably designed.
Suitably designed meaning they look like they should work.
Essentially, yes. Does the control, as designed, properly identify and mitigate the risks it's intended to address? Is there a clear logical linkage between the control activity and the risk? It's about evaluating the potential effectiveness based on the design.
Right. And then for Type 2 reports, you need evidence on operating effectiveness. How is that gathered?
This is where the actual testing comes in, and it's solely for Type 2 reports. The service auditor must test the necessary controls throughout the specified period covered by the report.
Can they rely on testing from last year's report?
No, that's a key point. Evidence from prior period engagements is not a sufficient basis for reducing the extent of testing in the current period. You generally have to test them fresh each time to confirm they operated effectively during this specific period.
What kind of tests?
The standard procedures, inquiry, asking management and staff how controls work, observation, actually watching the control being performed, inspection, reviewing documents, logs, and records that evidence the control operated, and sometimes reperformance. We also consider indirect controls. These are often higher-level controls, like management reviews or reconciliations that oversee or monitor more detailed process-level controls. And sampling is critical here.
How so?
The auditor needs to properly define the purpose of the test, determine an appropriate sample size based on risk and desired confidence, select the sample items representatively, and then carefully investigate any deviations or exceptions found.
What happens if they find deviations?
If a deviation is found, we have to investigate why it occurred. Was it just a one-off anomaly? Is it within an expected rate of error for that type of control? Does it indicate a need for more testing? Or is the control actually ineffective? In those rare anomaly circumstances, where a deviation is found but believed not to be representative of the control's overall effectiveness, the auditor needs a very high degree of certainty, usually through extensive additional procedures, to support that conclusion.
What about using the work of the service organization's own internal audit function? Can the service auditor rely on that to reduce their own testing?
This is a really important and often tested area. The service auditor will first need to obtain an understanding of the internal audit function, IAF, to see if its work is relevant to the SAE 3402 engagement.
And if it is relevant?
If it is, the service auditor must evaluate the IAF's objectivity. Are they independent enough? Their technical competence, whether they apply due professional care, and how effectively they communicate. This evaluation helps determine whether and to what extent the service auditor can use the IAF's work.
Can they refer to the IAF's work in their report?
This is the critical distinction for exam purposes. The service auditor cannot refer to the internal audit function's work in the opinion section of their assurance report. The opinion must be solely the service auditor's.
But can they mention it elsewhere?
Yes. If the IAF's work is used for performing tests of controls in a Type 2 report, the separate description of tests section of the report can describe the specific work performed by the internal auditors that the service auditor used.
But the responsibility remains with the service auditor.
Absolutely. The service auditor retains sole responsibility for the opinion expressed in the report. They can use the IAF's work as part of their evidence base, but the ultimate judgment and the signature on the report are entirely theirs. Two other vital requirements quickly: written representations and considering subsequent events.
Right, representations first.
Service auditors must obtain written representations from the service organization's management. This formally reaffirms their assertion about the system and controls, confirms they provided full access to information, and importantly, discloses any known noncompliance with laws, any instances of fraud, significant control deficiencies they're aware of, or any significant subsequent events.
And subsequent events, what's the focus there?
The service auditor needs to actively inquire about any significant events that occurred after the period covered by the report, but before the date the service auditor actually signs their report. These events could significantly affect the report's relevance or accuracy. If management knows about such an event but doesn't disclose it, and the service auditor becomes aware, the service auditor has an obligation to take steps to ensure users aren't misled, which might involve modifying the report or discussing it with governance.
Okay, so once all this intensive work is done, how does the service auditor actually prepare the service auditor's assurance report? What does that final document look like?
As you'd expect, this report is also highly structured, designed to convey all the key information clearly to user entities and their auditors. It needs a clear title: Independent Service Auditor's Report, or similar. It must specify the addressee and precisely identify the report itself. For example, Type 1 or Type 2, the system covered, the period or date.
What about scope and criteria?
Absolutely. It needs to clearly define the scope of the engagement, including mentioning any parts of the service not covered, identifying those complementary user entity controls we discussed, and stating how subservice organizations were treated, carve-out or inclusive. It also identifies the criteria used, for example, COSO, specific control objectives.
Responsibilities.
Yes, it states the intended users, clearly sets out management's responsibility for the system description, their assertion, control design, and operation, and equally clearly states the service auditor's responsibility. This includes emphasizing they express an opinion based on procedures performed in accordance with SAE 3402, and crucially, stating they are not responsible for things like updating the report later or reissuing historical reports.
And the procedures and opinion.
The report provides a summary of the procedures performed. Importantly, for Type 1 reports, it explicitly states that no procedures on operating effectiveness were performed. It will also include standard language about the inherent limitations of any system of internal control. And here's another key point. The service auditor's opinion is expressed in the positive form.
Positive form, unlike the negative assurance for PFI assumptions.
Exactly. Here, the service auditor positively affirms whether, in their opinion, the description is fairly presented, the controls are suitably designed, and, for Type 2 reports, whether the controls operated effectively.
And Type 2 reports have more detail.
Yes, Type 2 reports also include that detailed description of the tests of controls performed and their results. This includes describing any deviations found, even if those deviations didn't ultimately prevent the overall control objective from being achieved. Transparency is key.
Okay, and what about modified opinions in the context of SAE 3402? When would the opinion not be clean?
Just like in other assurance engagements, the service auditor's opinion will be modified, meaning qualified, adverse, or even disclaimed under specific conditions.
Such as?
This happens if the service organization's description isn't fairly presented in all material respects, or if the controls aren't suitably designed materially, or, for a Tech 2 report, if the controls didn't operate effectively throughout the period, again, in all material respects.
Or if they can't get enough evidence.
Exactly. A modification, specifically a disclaimer of opinion, is also necessary if the service auditor is unable to obtain sufficient appropriate evidence to form an opinion, perhaps due to a scope limitation imposed by management. These modifications are critical signals to the user entities and their auditors, warning them that there are significant issues with the control environment they might be relying on.
Let's test your understanding too. Imagine Banzi Group, a big educational institution, outsources its entire student application process and all the fee collection to a company called Easy Solutions Ltd. The auditors of Banzi Group obviously need assurance on the controls at Easy Solutions. What type of report should Easy Solutions auditors provide specifically for Banzi Group and its auditors to use, according to SAE 3402?
Okay, good scenario. The key here is what the auditors of Banzi Group need. They're concerned about critical, ongoing processes, student applications, and fee collection. They aren't just looking for a snapshot of control design at a point in time. They need assurance on the operating effectiveness of those controls throughout the year to potentially rely on them for their own audit of Banzi Group's financials.
So, that points towards.
That immediately tells us they require a Type 2 report from Easy Solutions service auditors. A Type 1 report simply wouldn't give them the evidence they need about operating effectiveness over the period.
And this fits with SA 402 for the user auditor.
Perfectly. SA 402 guides the user auditor, Banzi's auditor, on how to understand and evaluate the service organization's Easy Solutions controls that affect the user entity's financial reporting. A Type 2 report provides exactly the kind of evidence SA 402 anticipates for assessing reliance.
And the opinion in that Type 2 report would be?
The opinion in that Type 2 report would offer positive assurance on three things: the fair presentation of Easy Solutions' system description, the suitable design of its controls, and, most importantly for Banzi's auditors, the effective operation of those controls throughout the specified period, likely the year. It would also include that detailed description of the tests performed and the results, giving Banzi Group's auditors the substantive evidence they need.
All right, let's pivot now to our third and final standard for today's deep dive, SAE 3420. This one's titled, Assurance Engagements to Report on the Compilation of Pro Forma Financial Information Included in a Prospectus.
Yes, another quite specific standard.
It sounds very particular, tied directly to prospectuses. Can you sort of paint a picture of its core purpose? When would we encounter this?
It is very specific and highly relevant in the world of capital markets, especially during significant corporate events like mergers, acquisitions, or major financing activities that require a prospectus. SAE 3420 deals with reasonable assurance engagements, where a practitioner or professional accountant reports on the responsible party's compilation of what we call pro forma financial information, or PFFI.
PFFI.
Okay. This PFFI is typically found within that prospectus document. Its inclusion is often a requirement under securities law or just accepted market practice when a company is undergoing a major transaction.
So what's the accountant reporting on?
Think of it as a special, focused report. It verifies that certain hypothetical financial statements, which show the what-if impact of a major transaction like a big acquisition, have been put together, compiled correctly, and consistently following specific rules. This is for potential investors or other stakeholders reading that prospectus.
Okay, so pro forma financial information, what exactly is that? And what's its unique purpose, especially if you said it's hypothetical or illustrative?
Right, that's the key distinction to grasp. PFFI is financial information that's shown with adjustments. These adjustments are applied to unadjusted financial information, like historical statements, to illustrate the impact of a significant event or transaction.
Like an acquisition.
Exactly, like an acquisition or maybe a major divestment or a significant restructuring, as if that event or transaction had actually occurred at an earlier date.
Ah, so it's showing a what if it happens sooner picture.
Precisely. For example, if Company A acquires Company B halfway through the financial year, the PFFI might show what the combined financial statements, income statement, balance sheet, would have looked like for the entire year if that acquisition had happened right back on January 1st.
Okay, I see the purpose. It helps compare apples to apples, maybe?
Kind of. Its stated purpose is solely to illustrate the impact of that significant event on the unadjusted financial information. It does this by applying specific pro forma adjustments.
Hmm.
And this is an absolutely crucial point, especially if you're studying this. PFFI does not represent the entity's actual financial position, financial performance, or cash flows. This cannot be stressed enough.
It's not real historical data.
Correct. It is purely illustrative. It's designed to help investors, analysts, and other decision makers in capital markets understand the potential financial consequences of a specific transaction. But it's emphatically not a record of actual past performance, nor is it a prediction or forecast of future results. It's a tool for scenario analysis based on historical data adjusted for a specific event.
Given that it's so illustrative and focused on adjustments, what exactly is the practitioner's responsibility in an SAE 3420 engagement? I'm guessing they're not actually creating this PFFI themselves.
That's absolutely correct. The practitioner, the accountant signing the report, has no responsibility to compile the PFFI. That job belongs entirely to the responsible party.
Which is usually.
Typically the entity's management. They are responsible for identifying the event, determining the adjustments, and actually putting the PFFI together.
So what is the practitioner's sole responsibility then?
Their sole responsibility is to perform procedures to obtain reasonable assurance and then report on whether the pro forma financial information has been compiled in all material respects by the responsible party on the basis of the applicable criteria.
Okay, compiled based on the criteria. So they're
Yep.
checking the assembly process.
In essence, yes. It's a reasonable assurance engagement, so they perform sufficient procedures to get a high level of confidence. They're assessing things like, do the criteria management used provide a reasonable basis for compiling this PFFI? Do the specific pro forma adjustments made accurately reflect the impact of the transaction according to those criteria? And does the resulting pro forma column correctly apply those adjustments to the unadjusted information?
Checking the math and the logic of the adjustments, basically.
And checking consistency with the criteria, yes. What this engagement does not involve is equally important to understand. It's not about the practitioner updating or reissuing any audit or review reports on the historical financial information that was used as the starting point for the PFFI.
So they don't re-audit the base numbers.
No. Nor does it involve performing a new audit or review of that underlying historical financial information itself as part of this engagement. The practitioner's focus is narrowly, specifically on the compilation process, how the PFFI was put together, and the appropriateness of the pro forma adjustments made, all judged against the applicable criteria.
Okay, that's a very clear boundary. Let's break down the actual steps involved in such an engagement. Like the other standards, it must start with engagement acceptance, right?
Yeah.
What does a practitioner need to confirm before even agreeing to do this work?
Yes, acceptance is key. There are several critical checks. First, the practitioner needs to be satisfied they have the necessary capabilities and competence. This is specialized work.
Makes sense?
They also need to be satisfied that the applicable criteria, the rules used for the compilation, are suitable for the purpose, and importantly, that the resulting PFFI, once compiled according to those criteria, is unlikely to be misleading for users of the prospectus.
What if the law prescribes specific wording for the opinion?
Good point. If specific opinion wording is prescribed by law or regulation, the practitioner must ensure they can actually express that opinion based on the work required by SAE 3420. Sometimes regulatory wording might imply a scope broader than just compilation.
What about the underlying historical data?
That's a significant consideration. Was the source historical financial information audited or reviewed? Were there any modified opinions or emphasis of matter paragraphs in those prior reports? Because issues in the source data could impact the PFFI.
What if the source data was never audited or reviewed? Say, for an acquired private company?
If the historical information hasn't been audited or reviewed, the practitioner needs to carefully assess if they can still gain a sufficient understanding of that source information to perform their work on the compilation. It adds complexity.
An agreement with management.
Absolutely essential. They must have a clear agreement, usually in an engagement letter, with management, the responsible party, confirming their responsibilities. This includes adequately disclosing the criteria used, taking responsibility for compiling the PFFI accurately based on those criteria, and providing the practitioner with full, unrestricted access to all relevant information and personnel.
Okay, so the groundwork is laid. Once accepted, what goes into actually planning and performing the engagement? You mentioned the criteria are key.
They absolutely are. A huge part of the work is assessing the suitability of the applicable criteria. These criteria, whether from regulation or accounting standards, must include several key elements.
Such
They must state that the unadjusted financial information comes from an appropriate source, meaning it's reliable and relevant, like audited financial statements. And then, critically, the criteria must define how the pro forma adjustments should be determined. These adjustments must meet three stringent requirements.
3 requirements for the adjustments. Okay, what are they?
1. They must be directly attributable to the specific event or transaction being illustrated,
Directly attributable, meaning
meaning they arise solely because of that specific event. For example, if a company acquires another business, adjustments for transaction costs or purchase accounting are directly attributable, but adjustments reflecting, say, future expected synergies or costs of closing redundant sites after the deal is done, those are generally not directly attributable to the transaction itself. They relate to future management actions.
okay. Strict link to the event. What's number 2?
2. They must be factually supportable. This means the adjustments must be objectively determinable and backed by verifiable evidence. Think signed purchase agreements, financing documents, laying out interest rates, independent valuation reports, relevant tax laws, and rates. You can't just plug in an estimate or a guess.
Needs hard evidence. And number 3.
3. They must be consistent with the entity's applicable financial reporting framework and its accounting policies. So, if the entity uses IFRS, the adjustment should reflect IFRS principles and be consistent with the entity's established accounting policies. This ensures consistency and comparability.
Okay, directly attributable, factually supportable, consistent policies. What else about the criteria?
Beyond the adjustments, the criteria also need to ensure appropriate presentation and disclosures are provided within the PFFI section of the prospectus. And of course, the criteria must align with any relevant laws and regulations and ultimately ensure the resulting PFFI is unlikely to be misleading to a reader.
Materiality comes into play too, I assume.
Yes, materiality is considered in the context of whether the PFFI is fairly compiled in all material respects based on the criteria. An error in compilation or an inappropriate adjustment would be material if it could influence the economic decisions of users relying on the PFFI.
And understanding the deal.
Crucial. The practitioner needs to gain a thorough understanding of the compilation process. This means understanding the significant event or transaction itself, how the responsible party actually compiled the PFFI step by step, the nature of the entity and any company being acquired or divested, relevant industry, legal and regulatory factors, and the applicable accounting framework and policies used. Then comes the core work. Obtaining evidence. This happens on several layers.
So layer 1.
First, checking the source of unadjusted financial information. The practitioner determines if it came from an appropriate source. As we discussed, if this source historical information hasn't been audited or reviewed, the practitioner performs specific procedures to get comfortable about its appropriateness, maybe reviewing prior audit reports if available, making inquiries, performing analytical procedures or comparisons.
Layer 2, the adjustments.
Exactly. Assessing the appropriateness of pro forma adjustments. Did the responsible party identify all the necessary adjustments required by the criteria? And then applying those 3 tests we just talked about. Are the adjustments truly directly attributable? Are they factually supportable? And the practitioner might need to perform extra procedures here if acquired divestee financial info wasn't audited reviewed. And are they consistent with the accounting framework policies?
Layer 3, presentation.
Right. They evaluate the presentation to ensure the PFFI illustrates the impact of the event in a non-misleading way, and critically, that all the necessary disclosures are there.
What kind of disclosures are needed?
Things like the nature and purpose of the PFFI itself, the source of the unadjusted information, a clear and detailed explanation of each pro forma adjustment made, a description of the applicable criteria if they're not publicly available, like in regulation, and that prominent statement reminding readers that the PFFI is illustrative only and doesn't represent actual results.
Anything else on evidence gathering?
Yes, 2 more points. The practitioner reads other information in the prospectus, the parts outside the PFFI, to check for any material inconsistencies with the PFFI. And they consider subsequent events occurring after the PFFI date, but before their report date, to see if anything significant happened that might require reference or disclosure in the PFFI notes to prevent it from becoming misleading.
That sounds incredibly detailed, really scrutinizing how it was put together. What about written representations from management here? Still need...
Absolutely essential, yes. The practitioner requests formal written representations from the responsible party management confirming key things again: that they believe all appropriate adjustments required by the criteria have been identified and applied, and that the PFFI has indeed been compiled in all material respects on the basis of those applicable criteria. It's their formal sign-off on the compilation process. Once all that evidence is gathered and evaluated, the practitioner moves to forming the opinion.
A conclusion of the matter.
Exactly. This is where they conclude on whether the PFFI has been compiled in all material respects by the responsible party on the basis of the applicable criteria. This opinion is grounded in whether they've obtained sufficient appropriate evidence and carefully evaluated whether there are any material omissions, inappropriate adjustments, or other compilation errors.
And the opinion can be clean or modified.
Right. An unmodified opinion means the practitioner concludes the PFFI has been compiled in all material respects based on the criteria. However, if the PFFI is not compiled in all material respects, maybe a required adjustment was missed or an incorrect one was made, then a modified opinion is issued. This follows the general framework for assurance engagements. So it could be a qualified opinion, an adverse opinion, or even a disclaimer if there was a major scope limitation.
Can they add emphasis paragraphs?
Yes, an emphasis of matter paragraph can be used. This draws attention to a matter that's fundamental to understanding the PFFI and is already properly disclosed in the PFFI or its notes, perhaps highlighting the illustrative nature or a particularly significant assumption, provided it doesn't actually affect the practitioner's opinion on the compilation itself. It just adds focus.
Okay. And finally, what does the actual assurance report for SAE 3420 look like? What are the key components?
Again, it's a very specific report designed for clarity, especially in the context of capital market transactions. It starts with a clear title, usually something like Independent Practitioner's Assurance Report on Compilation, and identifies the addressee, often the board of directors or the company itself.
What does the main body cover?
It has introductory paragraphs that clearly identify the PFFI, what it is, the period it covers, the source of the unadjusted information, the significant event being illustrated, and the applicable criteria used for its compilation. It must clearly state management's responsibility for that compilation.
And the practitioner's responsibility.
Then, crucially, it outlines the practitioner's responsibility to express an opinion on that compilation based on their procedures performed in accordance with SAE 3420. And, importantly, the report explicitly emphasizes that the practitioner has not audited or reviewed the underlying historical information as part of this engagement, and repeats that the PFFI is illustrative only.
And the opinion itself.
It includes a statement that the engagement was performed in compliance with SAE 3420, summarizes the procedures undertaken at a high level, and then provides the opinion itself. The wording is specific, typically stating something like, "In our opinion, the pro forma financial information has been compiled in all material respects by the responsible party on the basis of the applicable criteria," or sometimes regulatory wording like "properly compiled on the basis stated."
And the usual closing elements.
Yes, followed by the practitioner's signature, the date of the report, which should be close to the prospectus date, and the place of signature. Every element is there to ensure transparency, manage expectations, and prevent any misunderstanding about what the report does and does not provide assurance on.
Okay, wow. We've covered a huge amount of ground there, really getting into the weeds of PFI under 3400, service organization controls with 3402, and now pro forma financial information compilation under 3420.
Definitely 3 meaty standards.
So let's try and bring it all together. Let's use an integrating case study straight from the source material we're looking at, designed to put these concepts into a practical exam-style scenario. This is the XP Limited case study.
Okay, let's see how it connects.
Right. So XP Limited, they're currently a paint manufacturer, but they're planning a big diversification, launching a completely brand new food processing plant project up in Nenoeda.
Okay, big strategic shift.
Exactly. Now, to secure the necessary financial assistance from bankers, they need loans. They've tasked Chirag, who's a senior finance exec with an MBA, to prepare detailed projections for this new venture.
Makes sense. Banks always want projections.
And Chirag has apparently done a very comprehensive job. He's prepared a study including expected sales, projected profits, key financial ratios, and critically, things like debt service coverage ratios over the next 7 years, plus payback period and the internal rate of return, IRR. He's even included charts and diagrams to make it look good.
Sounds thorough.
But the bankers are sophisticated. They're not just taking the report as is. They require an assurance report from a professional accountant on this entire study before they'll even consider lending the money.
Right, so this immediately triggers SAE 3400.
Exactly. So let's break down this case first, applying the SAE 3400 principles we discussed earlier. What are we looking at here?
Okay, first, Shirag's study is definitely prospective financial information. No question there.
And is it a forecast or a projection?
Given it's for a completely new line of activity, the food processing plant, and it's being used to seek future financial assistance based on events that aren't necessarily certain to happen, like achieving those sales targets, it clearly fits the definition of a projection.
Okay, so it's PFI, specifically a projection.
Correct. It contains all those typical elements we discussed.
Yeah.
Future sales, profits, key ratios like debt service coverage, investment metrics like IRR, payback period, all over a multi-year horizon, 7 years here.
And the purpose.
The case explicitly states the purpose. Submission to bankers for borrowing purpose. This is important for the auditor's report later. Now, the case also mentions that C.A. Dillip has been given instructions to examine this PFI. And look at those instructions, they directly mirror the standard. C.A. Dillip must examine if the PFI is based on assumptions, whether those assumptions are not unreasonable and consistent with the purpose, and if the information is consistent with past financials, where relevant, though less so for a new venture, and uses appropriate accounting principles.
So the instructions match the duties of the member examining PFI from SAE 3400.
Precisely. It sets the stage for what the assurance engagement should cover.
Okay. Now the case study gets interesting. It presents a draft report prepared by a staff member who, let's just say, is apparently not quite familiar with the specific requirements of SAE 3400.
The classic spot the errors scenario. Very common in exams.
Exactly. So I'm going to read out the relevant sections of this draft text of the Report on Examination of Prospective Financial Information prepared for XP Limited. As I read, listen closely for anything that seems missing or incorrect or just, well, off, based on everything we've just discussed about SAE 3400 reports.
Okay, ready?
Report on examination of prospective financial information to the Board of Directors, Top Edge Limited.
Pauses. Wait, Top Edge Limited. The case was XP Limited. Okay, maybe just a typo in the case material itself. Let's assume it means XT Limited. We have examined the projection of the upcoming project to come up at Ratnagiri. And pauses CSPI.
No, the case said NOIDA. Okay, focus on the SE 3400 aspects.
Of Top Edge XP Limited for the period from April 2024 to March 2030, as given in the prospective financial information from page 1 to 250, in accordance with Standard on Assurance Engagement 3400. The examination of prospective financial information, issued by the Institute of Chartered Accountants of India. The preparation and presentation of the projection is the responsibility of the management and has been approved by the Board of Directors of the company. Our responsibility is to examine the evidence supporting the assumptions, excluding the hypothetical assumption, and other information in the prospective financial information. The projection has been prepared using a set of assumptions that include hypothetical assumptions about future events and management's actions that are not necessarily expected to occur. We have carried out our examination of the prospective financial information thoroughly. Further, in our opinion, the projection is properly prepared on the basis of the assumptions as set out in Note 1 to 50 to the prospective financial information and on a consistent basis with the historical financial statements using appropriate accounting principles. Even if the events anticipated under the hypothetical assumptions described above occur, actual results are still likely to be different from the projection, since other anticipated events frequently do not occur as expected, and the variation may be material. For PCK & Co., Chartered Accountants, signature, designation, membership number.
Okay, thanks for reading that. Even setting aside the potential company name-location typos in the source, this draft is, let's say, suboptimal from an SAE 3400 perspective. It's a great example for spotting common mistakes. Let's pinpoint some crucial omissions and errors, and more importantly, why they are errors based on the standard.
All right, hit me. Error number 1.
Well, the address C. The draft says, to the Board of Directors. While the board might receive a copy, the case explicitly states the purpose is submission to bankers for borrowing. The primary intended users are the bankers. So the report should really be addressed to them, or at least explicitly reference them as the intended users for whom the report was prepared. It's about tailoring the report to its audience and purpose.
Okay, addressee needs fixing. What's next?
Second, look at the statement about responsibility. Our responsibility is to examine the evidence supporting the assumptions, excluding the hypothetical assumption.
Whoa, wait. excluding hypothetical. We just said the auditor does look at those.
Exactly. This is a major misstatement and shows a fundamental misunderstanding. The auditor absolutely does need to examine the hypothetical assumptions specifically to be satisfied that they are consistent with the purpose of the projection and are not clearly unrealistic. The wording in this draft wrongly implies no examination of the very assumptions that make it a projection. That completely undermines the report.
Okay, huge error there. What else?
Third, and this is probably the most critical omission in any PFI report, especially for exam purposes. The draft completely misses the required negative assurance phrase regarding the assumptions.
That key phrase we kept emphasizing.
Yes, it must include wording to the effect of, based on our examination of the evidence supporting the assumptions, nothing has come to our attention which causes us to believe that these assumptions do not provide a reasonable basis for the projection, assuming that, and then typically refer to the hypothetical assumptions. This isn't just a missing sentence, it's a failure to provide the specific type and level of assurance required by SAE 3400 for the assumptions. Without it, the report is fundamentally deficient.
Got it. Critical omission. Number 4.
Fourth, remember we said that for projections, the report must include a specific reference to its purpose and also a caution to readers that it might not be appropriate for other purposes.
Yes, because of the hypothetical nature.
Right. This draft correctly notes it uses hypothetical assumptions, but it completely fails to explicitly state its specific intended use, i.e., for submission to bankers for borrowing, and, crucially, it omits that vital caution against using it for other purposes. That caution is explicitly required by paragraph 29 of SAE 3400 for projections. It's essential for managing user expectations.
Okay, missing purpose and caution. Anything else?
Fifth, a smaller point but still a requirement. The date and place of signature are just left blank in the illustrative format here. These are required elements. The date confirms when the fieldwork essentially concluded, and the place is standard practice. They need to be filled in.
Right. And one more.
And finally, that phrase. We have carried out our examination of the prospective financial information thoroughly. It sounds positive, but it's too casual and vague for a formal assurance report. The standard phrasing is usually that the examination was conducted on a test basis, or similar wording reflecting the nature of assurance procedures. Thoroughly could misrepresent the nature and extent of the work, potentially implying a level of exhaustive 100% review that's neither practical nor intended for PFI.
Wow. Okay, that draft report was riddled with issues. Excellent breakdown. Now, this case study also includes some multiple choice questions, which are great for reinforcing these core concepts, just like you might see on an exam. Let's run through them.
Sounds good.
Question 1. Whose responsibility is to list out assumptions underlying prospective financial information? The options are A, professional accountant issuing the report, B, auditor of the company issuing the report, C, management of the company, D, banker of the company.
Okay, this one should be straightforward based on our discussion. The correct answer is unequivocally cease management of the company. Because, as SAE 3400 makes abundantly clear, management holds the primary responsibility for the preparation and presentation of the PFI. This explicitly includes the identification and disclosure of the sources of information, the basis of forecasts or projections, and the underlying assumptions. The professional accountant's role is to examine those assumptions and the compilation process, not to create or list the assumptions themselves. It's management's plan or scenario. The auditor just assesses and reports on it.
Perfect. Question 2. Which of the following statements is most appropriate regarding the use of prospective financial information to be included in such a report? A. Intended use of projections is required to be disclosed. It is further necessary to caution the users regarding inappropriateness of projections for other purposes. B. It is discretionary to state intended use of projection in such a report. C. Intended use of projection is required to be disclosed. It is not necessary to caution the users regarding inappropriateness of projections for other purposes. D. It is prerogative of management to use report in the manner it deems fit.
The most appropriate statement here is clearly A.
Why A?
Because, as we hammered home when discussing the report contents, specifically for a projection, which this case involves, the standard requires the report to clearly state its intended use, submission to bankers here, and explicitly include that caution warning readers that using the projection for other purposes may be inappropriate. Options B, C, and D are incorrect because disclosure of use and the caution are mandatory for projections, not discretionary or unnecessary, and management certainly can't just use the auditor's report in any manner they deem fit, especially if it's restricted.
Got it. Mandatory use and caution for projections. Question 3. Which of the following statements is most appropriate regarding the examination of PFI by a chartered accountant in accordance with SAE 3400? A. Accuracy of projections is vouched for based upon performing procedures thoroughly. B. Projections can go haywire. It depends upon the professional judgment of the chartered accountant to vouch for the accuracy of projections. C. Accuracy of projections is not at all vouched for in an assurance report on prospective financial information. D. The matter of accuracy of projections or otherwise is not domain of such an examination. Therefore, there is no reporting requirement under SAE 3400.
Right, this tests that core principle again. The correct answer, without a shadow of a doubt, is C. Accuracy of projections is not at all vouched for in an assurance report on prospective financial information.
And the reasoning.
It goes straight back to that fundamental limitation we discussed, the speculative nature of future evidence, and importantly, that professional misconduct clause in the Chartered Accountants Act. A CA cannot vouch for accuracy. Option A is wrong because you can't vouch for accuracy no matter how thorough the procedures. Option B is wrong because professional judgment doesn't override the prohibition on vouching for accuracy. Option D is wrong because while accuracy isn't vouched for, the examination of the PFI and its underlying assumptions is the domain of the engagement, and there are specific reporting requirements under SAE 3400, like negative assurance on assumptions and opinion on compilation. So C is the only correct statement.
Excellent. Last one. Question 4. Which of the following statements is most appropriate regarding UIN in context of examination of prospective financial information by a chartered accountant? A. It is mandatory to state UDIN in such type of reports. B. It is desirable to state UDI in such type of reports. C. It is not required to state UDI in such type of reports as it is not an audit engagement. D. It is not required to state UDIN in such type of reports as it is not an engagement related to historical financial information.
UDIN. This question is interesting because it steps slightly outside the direct content of SAE 3400 itself and into broader professional compliance requirements in India.
So what's the answer?
Well, SAE 3400 outlines the required elements and substance of the assurance report, the title, addressee, opinion, caveats, etc. It doesn't mention UDIN, Unique Document Identification Number. However, the Institute of Chartered Accountants of India, ICAI, has made generating and quoting a UDIN mandatory for almost all certificates, reports, and documents signed by practicing CAs, including assurance reports like those issued under SAE 3400. This is a separate regulatory requirement aimed at ensuring authenticity and traceability.
So even though the standard doesn't mention it, it is required in practice.
Yes. Therefore, considering the practical reality and regulatory environment for a chartered accountant in India signing such a report, the most appropriate statement among the choices given is A. It is mandatory to state UDIN in such type of reports. While desirable B is true, mandatory is stronger. And C and D are incorrect because the requirement applies broadly beyond just traditional audits or historical information engagements. It's an overarching compliance point.
Great clarification. So understand the standards requirements for content, but also be aware of overlying regulatory requirements like UDI.
Exactly. Hashtag outro.
Well, what an incredible deep dive that was. We have journeyed through, I think, a really intricate part of the assurance world, focusing specifically on SAE 3400, 3402, and 3420.
We certainly covered a lot of ground.
We started with that fascinating challenge of providing assurance on future-oriented financial information, making that absolutely crucial distinction between forecasts, best estimates, and projections, hypotheticals, and reinforcing again and again that core principle: an auditor never vouches for the future.
You're validating the map-making process, not guaranteeing you'll reach the destination.
Exactly. Then we explored the vital role of SAE 3402 reports on controls at service organizations, learning that critical difference between a Type 1 design snapshot and a Type 2 operating effectiveness over time report, and why Type 2 is so invaluable for user auditors seeking reliance.
Understanding that Type 1 versus Type 2 difference is absolutely key.
And finally, we delved into the very specific world of SAE 3420, reporting on the compilation of pro forma financial information for prospectuses. Understanding it's purely illustrative, focused on specific adjustments, and requires rigorous verification of the compilation process itself, not re-auditing the underlying history.
3 distinct standards, each addressing a unique assurance need beyond the traditional audit.
It's really clear that understanding these standards deeply, getting into the nuances like we did today, prepares you not just for those challenging exams, but really for the dynamic and ever-expanding world of modern assurance services.
Absolutely. Those aha moments we hopefully shared, appreciating the different levels of assurance, understanding the caveats, recognizing common pitfalls in report drafting, like in the case study, that's what transforms just memorizing rules into genuine mastery and practical application.
Definitely.
And, if we connect this to the bigger picture, it's quite fascinating to just ponder how the role of the professional accountant continues to evolve.
What do you mean?
Well, as the financial world keeps innovating, as businesses become more complex, more global, more reliant on technology and outsourcing, the demand for transparency, for reliability across an ever broader range of information, even non-financial data like ESG metrics, is just going to keep growing.
So more demand for assurance beyond financials.
I think inevitably, yes, which leads to a provocative thought maybe for you listeners to mull over as you continue your studies or your practice.
Okay, leave us with something to think about.
As technology and business models continue to change at lightning speed, what new types of assurance engagements do you think will emerge in the coming years? Think about AI, blockchain, sustainability reporting, and how might these existing standards 3400, 3402, 3420 need to evolve, or what new standards might be needed to meet those future demands for trust and credibility in an increasingly complex world?
That's a fantastic question to ponder. What is the future of assurance? That really brings today's discussion full circle. Thank you for joining us on another deep dive. Keep exploring, keep questioning, and always strive to be well informed. We'll catch you next time.